Okay, hello everyone. Welcome to this week's weekly report, July 7th, 2024. I'm Mark Minervini, and this is Minervini on the market. Let's start off by taking a look at key components of market health. Major indexes are positive, along with up-down volume, both positive. The indexes, of course, have been chugging along here. New highs seems to be defying uh, gravity. New highs, new lows, of course, is neutral with individual stock participation also neutral, and that shows the thinness of those rallies where we're seeing a lack of participation, which we'll talk about in just a minute. We did, however, take the STEM model down to red. I think it's debatable whether, we're in a orange cautious environment. I think, on any one day we can make an argument that, okay, some things are working. On other days, we see volatility and it's a bit difficult. So I think we're sort of in between a rock and a hard place as far as the hard penny to cautious environment. But either way, it certainly is an environment that is not an easy dollar environment, but it is tradable. Um, Also, we had the SPY advisor models, the long-term SPY models raise some cash, which is somewhat abnormal, if you will, near the high. Sometimes usually you have to come in the market to get these trend models, but the one of them did our moving average trend model did pinch off 25% allocation on the 25 and 33% on the 33 model, which reduced both of them from fully invested 100% to 75% and 67%, respectively. Now, when we take a look here, looking at the 33 model, you could see went on that buy signal back here on January 13th. Now, since then, of course, we've laddered around a bit on the exposure. We came down to 67%, back up to 100, back to 67. And a couple ways you can play this one. You can see down here the allocation went from full cash to 100% invested. But once we get 100% invested with this model, we're laddering down until it gets to zero. And then that, of course, would be 100% cash. So now we did have a period where we had that pullback, that 10% pullback in the market going into September and November, where we raised two-thirds of the portfolio into cash, went down to 33% invested, 67% cash, back up to 100%. And now, again, just pulling in a little bit there, raising some cash. So a couple ways you can play this. One is to ladder with it, or you can also just use buy and sell signals, and that would be when you go on to a buy, which is 100%. When you go down to zero, you sell, which is similar results. However, you might get caught in if you had a quick downdraft, the laddering tends to get you out of those and raise some cash. So it's a sort of a toss up between the two. The FANG ETF has been getting extended and now very extended based on looking at Monalert and gauging from its own historic action. We've gone through a couple of natural reactions or pullbacks since we broke out of this pretty decent sized base. And now coming off of that second natural reaction, usually after you have when you're dealing with a stock at least, and this is of course a handful of stocks, it's going to act more like an individual stock, even though it's an index. When you go through a couple natural reactions and you start getting extended, usually the next pullback is a bit larger and you need to undercut some lows. So I think we're getting more and more risky as we run up here, and you really need to think about selling into strength if you're in the mega cap names and the FANG names and so forth. Taking a look at a composite. This is what they call a bubble composite, of taking bubbles and putting them together and then overlaying your current index, if you will, over them and seeing where you are historically. It's really not something that I would trade on, but looking at past bubbles, yeah, we moved up a lot in these in the fan mag names, but it doesn't mean we can't go higher. That's the one thing I want to point out. You've had recently Meta and some of these names, Amazon, have been breaking out of bases. Netflix, of course. Some names are extended a bit, and some are just starting to come out of bases. So while we may have a pullback here, sorry about that. While we may have a pullback, certainly you can't conclude that the end is here, and we've got a top because we haven't even seen any type of action of a stage three top building yet, let alone a stage four. Um, so let's take a look at and talk about Powell's comments last week. The latest inflation prints, he said, was suggest we're getting back on a disinflationary path. However, he added, we want to get more confident before cutting. And this is perfectly within his narrative that he's been following and made it clear that any one report isn't going to really be that meaningful. But we have gotten some some information coming in or some readings coming in that are definitely suggesting that things are softening a bit, even in the labor market. The unemployment rate, of course, rose to 4.1%. That's the highest it's been since 2021. As that turns up here, generally the labor market or the unemployment rate, I should say, moves inverse to the stock market. So as we're getting an uptrend here, this could put some pressure on the market. I know it was thought of to be a good thing as labor softens, we get rates to come down. But I assure you, at some point, we're gonna move from inflation fears to recession fears, and that could cause the market to come in. Everybody's waiting for rate cuts, but I wouldn't be surprised if, once we get rate cuts, everything's been baked into the cake and the market actually starts to roll over. So I wouldn't be too eager to worry about getting rate cuts. The market's been acting great with the current rate environment. Now, the 1 year did roll over here, and that's something I've been watching and waiting for to see how the bond market was going to view some of these recent economic reports. And this is, I think, the start of something significant, meaning that this is first, showing us that maybe we are softening here a bit, and maybe there will be a rate cut in September, by the end of the year. Again, as I mentioned in previous last week, with the way the home market is, existing home prices have soared. There's very little inventory. The market's at an all-time high. I find it very hard to believe that the Fed can cut aggressively. There might be one token, maybe quarter point cut, but I just don't see that happening. And why? We're in this really perfect Goldilocks situation here with the economy growing at a sustainable, moderate rate. And so I just don't. I think we're in a really good spot here still, and corrections here. Although we may have pullbacks and corrections, we still have to conclude that the bull market is still intact. Of course, I would defer to the models and defer to the stocks. Right now, the stocks are definitely telling us that it's getting more difficult, and you can see we raised some cash on the model. So we're going to defer to that. I'm giving you my opinion, though, sort of my forecast here. Looking at forecasts based on data, the presidential cycle tells us that we've got a strong tailwind, all right, a strong tendency going into next year, the second half of this year, into the first half of next year. But right now, sentiment, this is what's getting me most concerned, is we're up around the 63, 64% bulls reading on Investors Intelligence. And that's the nosebleed section. And you can move higher. You can see, when you come out of a bear market, you can get to those high levels and still move much higher. We've moved up a bit here, though, right? And we're coming back to those levels. The thing that also that I'm seeing here is that when we rolled over and we started looking like we were going to correct, we came back very quickly, and there's not much disbelief. People just came right back to the bullish camp, and that's where I think the frothiness is getting a bit much. And this is where the more that we get frothy here and the higher the market goes from this point on, I think you need to think about selling into the strength. When you look at the ratio, not just the bulls versus the bears, that ratio is getting up to those to those high levels too. Again, it can persist for a while, and maybe we just get a pullback. Cycle Composite says, pull back in the July August area, and then back to the upside, and then some pullback in September, late year, and have a year-end rally. But the tendency, of course, is to be to have the market up here in the second half of this year. This is where that volatility, I've been pointing this out for quite some time, and you might get tired of hearing it, but still we are very stretched on the time frame that we haven't had any type of volatility, and eventually that's going to rear its head. We've got some really low volatility here persisting, and like I said before, that's a great thing. That's exactly what we see in a lockout rally, and we may not get an overall just washout here. That we may just get a rotation, and again, this is another theme or idea that we've been talking about for a while. A lot of people are looking for the smaller caps, the Russell, with the rates rolling over now, or starting to roll over, I should say. And when I say rates, I'm talking about the 1 year that I just looked at. With the 1 year rolling over, maybe we're in that beginning stages of having some softening and the rates coming down, and that's good for the small caps, and that's what a lot of analysts are expecting. And you could see while we've moved up in the Nasdaq, the Russell has just moved sideways. And at some point, we are going to get money rotating out of the areas that have gotten themselves overvalued and in the areas that have been undervalued. And the Russell's been undervalued for a long time. And it doesn't mean it can't stay there, but certainly this is an area that we want to watch and be ready to start moving into small and mid cap names. And the thing that I'm afraid of is that people are so hopefully you guys aren't so conditioned in these big mega caps that you're not going to yield to the evidence that starts to show itself, and we see small caps starting to break out and mid caps out of bases. You want to buy them. You want to start buying those names. Don't be afraid that they're smaller names. That's opportunity. It's opportunity knocking. At some point, we're going to see that, and I'm waiting and welcoming that when it comes. The participation, again, we've been pointing this out for a while, and it's really persisting. But when it persists and we get down to these levels, you really have to look out below. Especially when you've got sentiment that's in the 60s, and these ratios that are bulls to bear in the 4 to 1, and you start to get this thin and persist like this. Like I said, this is where you get some the risk of downdrafts and at least short and intermediate term tops. You look at the and that was what we are just looking at. There was the percentage of stocks with their 50-day moving average only at about 30%. I'm sorry, 37%, and we're way extended from the 50-day, just like the 200-day. We're way extended from the 200-day, and we've only got about 40% of stocks above their 200-day moving average. Again, I've never seen this persist for any great length of time without having some type of correction after it, or fairly soon after. And we're once again we're overbought. We're in the overbought territory. Now, a market that stays overbought is a sign of strength longer term, but short term, it could lead to a pullback. And again, even if you look at the S&P 500 percentage of stocks above their 50-day, about 45%. So with the market acting so well, and I say the market, the indexes, and you look beneath the hood and you see participation, really diverging. This is a market that you just have to keep one foot by the door. And I didn't change one comment here from last week's summary. We're pretty much in the exact same position. Overbought. We're seeing divergences. Participation certainly is light. Volatility has been low, and I would look for some type of pickup coming from the type of sentiment levels that we have. And if sentiment gets more bullish from here and we move higher from here, I would sell right into that strength. As a matter of fact, as the market should start downturning, I might even go short. Of course, I tried the Qs, didn't work, got stopped out. But I would be willing to, from a low risk standpoint of maybe a very tight single digit stop, go back in on the short side and maybe even get more aggressive this time. You want to be selective and tight with your buys, as you know, with the select trade portfolio, the Mini Select trade portfolio. We are being very, very cautious, and you can see very tight. And I'm going to talk about that. I'm not going to steal the thunder now. We'll talk about that this week coming up with a study session, and we'll go over the trades. Not much to talk about, of course. We've gotten stopped out of pretty much everything. A couple names remaining, about 50% invested, of course. Traction is what you should be gauging. If you're getting traction, great. Then you trade in this market. If you're not, you got to be more cautious and you got to pull back your horns. Tomorrow, of course, we'll have Q&A with myself and Mark Ritchie live at 11:30. Thursday, Mark Ritchie and Brandon as normally scheduled, or as they will schedule, usually around 12 o'clock. Weekly study session. We'll announce that, but we're gonna do a weekly study session looking at the Intermini Select Trade portfolio. And then again, I like to at some point do another tutorial and discussion and maybe bring in the analytics section into that. Let's see what else. Let's take a look at some stocks. We can go over here. There we go. Um, so the stocks have been sort of a mixed picture, and we've seen a little bit of volatility, but then some of the names are coming ripping back here, like an AMD. And this is normal if you're, bottom fishing. Sometimes you don't get it right, and you got to jockey for position. So we come ripping back on AMD here. We still own a little position. Chef, SHEF, Chef's Warehouse, came out of that tight that nice tight right side there, if you will, or base. A couple of days up here. A couple of names that we had on either open or on focus list. Dare, of course, I put on short sale and started coming off here, so that's doing what it should do as far as the short's concerned. And speaking of that, IBIT got crushed. And let me take all this junk out of here. We got all kinds of stuff. This is what I was looking for to happen. Remember, I was looking for it to tighten up here. Didn't do that. Came off. I was looking for it to rally up and tighten up some more. Didn't do that. So this is going in the complete opposite direction of what I was hoping for, and that means that we need to just wait and stay away for now. Of course, if you're a bottom fisher and you want to get a lower price on Bitcoin, well, then you're pretty happy here, and it's trading right near these lows. We'll see if it holds, but yeah, we came down in a gap there on Friday, looking pretty ugly. Coin is holding up a lot better, surprisingly. Came off in the downdraft of Bitcoin, but closed right on the high, and that caused some of these ETFs like Block to also trade up near the highs, and a pretty nice base forming in the blockchain ETF here, and also CRPT, which is another crypto. This is Skybridge crypto, putting in a base here. So that's interesting. INSM came ripping back. I was looking to add back some on this right over here as it pulled back. I was hoping we got a little bottom fishing pivot. Instead, we came off and we undercut the 20-day, came all the way back close to the breakout, and then just came ripping back on Friday. Of course, fundamentally, as you know, I like this company of what's going on with the phase 3 trials, and we still have a small position in it up, so I don't neighborhood of 17% or so, 20%. It was up almost 13% on Friday. CORZ, I'm sorry, had that little shakeout and now a good close and staying tight here. I like that action. This is a candidate for potential power play, so definitely one that we would have on focus list. MDGL is one that has a larger base here. Big right side building. I'm sorry, big base building forming this right side here. So keeping an eye on that. Biotechs, of course, have been a huge, as far as I'm concerned, there's a biotech revolution, and there's a huge number of names that we're seeing in biotech. So lots of ideas coming from the biotech area. Just got to be selective. We've seen some volatility, and the way the volatility is handled, those pullbacks, is really important. And so far, the test is pretty good. Something like a KSPI, which rallied up, came back, wasn't doing exactly what we wanted here for a couple of days, but not getting, like I said, not a situation where you would just, punt the stock, but certainly it needed to get some support, and it did. And you saw it came ripping back pretty good here on Thursday, Friday. Now pulling back a little bit. If this could stay tight, get into new high ground. We've got some tennis ball action there. Same thing with something like oops, let me just get this. Sorry about that. PCVX. Another one where it broke out, came in, you had that volatility, the outside day. It was looking a little ominous, stayed tight, went inside, and Friday, pretty good action. This looks like we may have a shot at getting into new high ground and get a reversal recovery. As I always point out, when you after a breakout, stock comes back in, maybe not doing exactly what you think, but it's only a day or two. Give it a little time, see if it can stabilize within a week or two. Very often you're back in new high ground and you get that reversal recovery. Unless the violations are piling up, stick with your original stop. TMDX is one where, again, we had a little bit of volatility, similar situation where you set up, you broke out, you had a squat, and you came off a bit, and this was looking a little ominous. But since then, you've come back. You've been able to get new high ground and hold, so it's acting really well. You want to stick with that. If you're looking to have a little more excitement in your life, this stock, this SEZL, big decline here. I'll show you from here to here. Whoops, wrong tool. Big decline of about 60%. So this is really deep. You've gone through a bunch of iterations. You broke out over here, and you might look at this and say, wow, what a nice VCP. Why not buy it right here? Well, if you start measuring, this pullback here was 25%, and this little pivot, if you will, looks so little. It actually was is about 11, 12%. So it's a little bit excessive for me. And that volatility you can see came back and needed more time. It's tightening up a bit more now. So this may be a candidate. I think it's a little bit too much on the volatile side for me. Something like Goldman, we're seeing a rotation. We may not get a rotation necessarily into the small caps yet, but we may get a rotation into other quality names like the Goldman Sachs, and we've seen even within the group itself of say the mega caps, you've seen money rotate into Amazon, and Apple came ripping back. So again, I'm taking a look at stocks like Goldman that may set up a right side here. Also coming off the lows cheat areas like a TW, especially if it's in the small and mid cap area, I'd start looking for those. This is one that we'll put on focus list. Crowd, which CrowdStrike, of course, was a bit sloppy here on the right side, but it stayed really tight here. So if you look at a weekly, this is likely a 3-week tight. This is probably tradable, sticking in that more mega cap area. Let's see, something like an FRPT, also tight area here. EMR, just going through some names here. Here's another one where you get that cheat area. This needs to tighten up a bit. This big outside day, I believe, was on earnings. Now it's come back, and now you need more time there, but that's definitely on my watch list. LRCX is acting really well. This is one that I sold, maybe adding it back. This whole chip area is still quite strong. ONTO, of course, we added to focus last week. I think this could tighten up and maybe be viable. TTD, of course, has been holding up pretty tight here. Actually came out on Thursday, never followed through, but this looks like it looks like it wants higher. CRS, here's one that you're getting that right side. You got that accelerated move, but this is one that's a little bit earlier stage and not in the late stage sort of blow off stage. So I would maybe if this could tighten up, maybe consider that. PSFE, another one a little sloppy, up on earnings, come back here to the 50-day. Again, this isn't crisp yet, but I would take a look at this if this could tighten up on the right side. Uber, a lot of people have been looking at Uber as a potential bottom here. Came off the lows, trying to build this right side. 50 days just starting to flatten out here. So potential, maybe some money rotating into Uber. The area like IHG, of course, which we bought, and then we experienced this big down day. We got stopped out. I'm still not throwing in the towel as far as it being a potential setup. If it can come if it can tighten up and build this right side, I might still be interested, but I'm also watching some of the other names, particularly something like Hyatt, because you saw the same type of action here where it was looking pretty good. You got that outside day. It hasn't really fallen apart yet. So I'm watching them sort of as a group. Marriott's lagging a bit, but watching a few of these names, and that's a potential to go back in. GE, of course, has been just an amazing a high alpha name, acting like a small stock, yeah, like a small cap stock, but certainly a huge mega cap name that fell on hard times, was down something like 99% off the highs, off the when it topped in 2000. Took It's still probably not back to its old highs. I have to look at a longer term chart, and it's definitely not back to the 2000 highs. But aerospace, of course, that whole area has been quite strong, and GE is trying to set up after its first pullback here to the 50-day. It actually had a pullback over here down to the 200-day, and then made this next run. Definitely accelerated run, probably getting later stage, at least intermediate term. But this could set up maybe if it tightens up on the right side there. Let's see what else. What else? MNDY, one that had that pretty decent base up on earnings here, tightening up. Not much of a pivot, but it did try to break out on Thursday and Friday. So one that we put on focus last week. I'm not seeing a whole lot of ideas that I would say, "Whoa, wow, that's perfect right now. I'm ready to buy it." But the list is still relatively large, and there are some viable ideas. But I think the ice is thinning. Every day I see it thinning more and more and more. And then you start to get sort of these last of the Mohegan trades, these stocks that set up near the end and they suck you in. And so you got to just be progressively more and more careful here as you're seeing that thinning beneath the surface, and don't get sucked in with the indexes grabbing headlines. Watch the stocks and look where the money's rotating. And the main thing is the traction in your own trading. If you're not doing well in your own trading, then certainly there's no reason to get aggressive. Let's see. So we'll see you tomorrow and at 11:30 a.m. for live Q&A, and have a good rest of the day. It's about 12 o'clock in the afternoon right now on Sunday, and I'll talk to you later. Bye bye.